I do think that the central bank gold demand is significant in a number of ways. Again, the gold pricing scheme as it is now between New York and London relies almost entirely on forward contracts and futures contracts and all these different derivatives where 1 ounce of gold is levered nobody knows how many times, how much physical gold actually underpins the system that has all these derivatives floating on top of it. Think of it like a pyramid. There's 1 ounce of gold down here, and there's all these forward contracts and futures contracts. So as you remove ounces of gold from that base, the leverage just gets stretched even higher. So the central bank buying does play, just like all of us buying too, does play a role in creating a tightness in that system that will one day force a deleveraging of.
The precious metals market is experiencing a significant surge, with gold and silver prices reaching new heights amid changing economic expectations and increased retail investor interest. This trend aligns with the observations of Craig Hemke, a prominent figure in the precious metals and financial markets and the founder of the TF Metals Report. Hemke has long argued that the current gold pricing system heavily depends on futures and forward contracts, creating a leverage structure where physical gold underpins multiple derivative contracts. Recent data from CME Group Inc, the U.S.'s largest derivatives exchange, seems to support Hemke's concerns about market structure and growing investor interest. The average daily volume for micro-gold futures contracts has surged to 99,527 as of September 11th, surpassing the previous record of 86,101 lots set in 2020. This increased activity in micro-futures contracts indicates a growing interest from retail investors in the gold market. The surge in gold prices, up approximately 25% this year and repeatedly hitting record highs, is attributed to expectations that the Federal Reserve may soon begin a rate-cutting cycle. Spot gold reached an all-time high of $2,581.23 an ounce on Friday, while silver touched $30, reflecting the broader rally in precious metals. Hemke also points out that the U.S. government now spends over $1 trillion annually on debt service, which he believes contributes to the recent movements in precious metals markets. The recent rise in metal prices, following the release of U.S. Producer Price Index data for August, has drawn the attention of major players in the bullion market. Optimism about interest rate cuts has boosted risky assets and increased the appeal of non-yielding safe havens like gold, creating a positive environment for precious metals. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't know. There's so many ways to look at that. How do you go directly to a mine? Because mines don't produce metal. I mean, they send doré bars, and then those go off to a refiner, and then the refiner refines them down to the 4.9 standard of, in kilo bars or whatever. So I'm not sure, pick your country that's actively buying gold, Poland, or Turkey or, India, whatever. I'm not sure they'd go to a mine. It also kind of reeks of why don't they just nationalize their mines, and just say, hey, our metal is ours. So I'm not sure about that. But I do think that the central bank gold demand is significant in a number of ways. Again, the gold pricing scheme as it is now between New York and London relies almost entirely on forward contracts and futures contracts and all these different derivatives where 1 ounce of gold is levered nobody knows how many times, how much physical gold actually underpins the system that has all these derivatives floating on top of it. Think of it like a pyramid. There's 1 ounce of gold down here, and there's all these forward contracts and futures contracts. So as you remove ounces of gold from that base, the leverage just gets stretched even higher. So the central bank buying does play, just like all of us buying too, does play a role in creating a tightness in that system that will one day force a deleveraging of it. And we'll get to find out what the tide will go out, and we'll find out who's swimming naked. Who is it that's, they own nothing but, promises, promissory notes and warrants and contracts that don't have any gold at all. And they're going to look around and go, wait a second. I was told I had gold, and you don't unless you got the real thing. So anyway, central bank demand, very important element of why we keep moving higher. For the month of August, then this is from the Bloomberg report. I don't know if it was leaked, if they just let the headline number out. For the month of August, the U.S. government ran a budget deficit of $380 billion for the month. 11, 12 billion a day. It's remarkable. A billion every 2 hours, 500 million an hour. Am I doing the math right? I mean, now it doesn't annualize it like that, right? You can't just go, well, it's going to be, 400 billion a month for 12 months and annualize at 5 trillion, because there are months like April, right, where you get all these tax receipts, or every quarter, maybe June, September, and all that kind of stuff. But this kind of number is going to push the annual number when we get it early in October, when we get the look, because the US fiscal year ends on September 30th. The annual number is going to be 2 trillion or very close to it, which is just outrageous. And then we now are well past $1 trillion a year just in debt service. And so you put those things together and it got us some momentum. We got above that 2560 level and broke out. And, it had to be a whole bunch of stop orders there. People that were short that said, well, on a breakout, I better cover that. And so you've had this steady move up since. Silver's moving higher too. It just tapped $30. So we're having a good day.
Recent data and statements from Fed officials suggest a more measured approach to rate cuts than some market participants had anticipated. According to a Reuters poll, most economists expect the Fed to implement 25 basis point rate cuts at its 3 remaining policy meetings in 2024. This forecast contrasts with the more aggressive rate cut expectations that briefly emerged in the futures market following the release of August's jobs report. The Labor Department's latest Consumer Price Index report showed inflation continuing to moderate, with consumer prices rising 2.5% in August year over year, down from 2.9% in July. This marks the 5th consecutive month of declining annual inflation rates, the lowest since February 2021. The month-over-month increase was a modest 0.2%. This cautious stance is at odds with financial analyst Craig Hemke's perspective. Hemke has argued that economic slowdowns will likely be met with lower interest rates and increased quantitative easing, potentially leading to persistent inflation. He draws parallels between the current economic situation and the stagflation of the 1970s, suggesting that such conditions could be favorable for gold prices. Let's get back to the interview.
I just have it in my head. It was June of 2020 when I first started talking about it on my site. That's eventually where this was headed. We didn't know about the $5 trillion that was going to get spent, and flushed out of the economy to keep it rolling to and through COVID. But beyond that, you knew that, any type of economic slowdown, which would then be eventual, was going to be met with even lower rates again and more QE and all that kind of stuff. So the inflation was never going to go away the next time we had a recession. Well, then there you go. That's what stagflation is. It's inflation in a stagnant economy. Very similar to what we had in the 1970s. And I'm sure everybody watching this call has seen the charts, of what gold has done or had done back in the 1970s. Broke out. It was held at $35 an ounce, and then Nixon closed the gold window and it went from 35 to 200 in a couple of years, then pulled back 50% to 100. And then went to 800 a couple of years later. And again, I'm not trying to tell you, we're going up eightfold from here. But this stagflationary idea where negative real interest rates take hold is a very positive scenario for owning gold. Negative real interest rates. And what's a real interest rate? You take your nominal rate of interest, say it's 2% that you're earning, but inflation is 4%. You're actually losing 2% a year in cost of, and trying to keep up with the cost of living and all the other expenses that you have. You're not even keeping up. That's a negative real or inflation adjusted rate. And again, where this impacts gold as a foundational investment is for 15 years. Well, maybe not so much anymore. I always heard, well, gold doesn't pay a dividend. Right. That's fine. It also, it keeps you up with inflation, obviously. And when inflation is eating away at your savings that quickly, makes it look even better as a foundational investment versus treasuries and everything else. And that's what drives demand for it. And that's why it's so correlated over the years with negative real interest rates. The reason I call it the BLS BS is that monthly jobs number is cranked out by the Bureau of Labor Statistics, the BLS. And it's BS because it's just, how do they know how many jobs the US created when they issue the report on like the 3rd of the following month, right? Here's how many jobs we created in March. Well, it's only April the 2nd. How can you possibly know that? Well, it's because all this statistical gobbledygook based on the last 20 Marches, and they try to guess, it's all, and recently, and I'm sure most people know, you get a headline number of a certain number, and then the next month and the following month, those numbers are then revised lower. Okay, so it's just BS. Well, Elijah, I tell you all this. Not many folks know the same organization that cranks out the jobs report cranks out the CPI, the BLS, the Bureau of Labor Statistics. So when you see little things buried in that CPI report, for example, within the CPI, the calculation of health insurance costs has fallen 31% over the last 2 years. And because it rose in the first, if you look at a 5-year picture, it's down 10% only because it was rising in 2021 and 22. So the BLS is telling us that in health insurance costs have fallen 31% over the last 2 years or 10% over the last 5. That is demonstrably false, not just anecdotally, where, you and I are like, I don't know, that's not true. My health insurance costs are up. That is demonstrably false. Anybody can prove that it's up 31%, if anything, but yet as a factor of the CPI, we're told it's down.
As the market continues to evolve, the interplay between physical metal demand, derivative markets, and macroeconomic factors will likely remain crucial in determining the trajectory of precious metals prices. The current trend seems to validate Hemke's long-standing views on the gold market structure and its sensitivity to broader economic conditions. Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.